Hi, welcome to our first version of the valuation dashboard presentation series. What we're trying to do here is just have a quick 5-minute run through of the key issues for the week from the valuation dashboard, so which tracks valuations from right around the world in terms of equity markets, bond markets, and residential property. Over this week, so it's divided into 6 sections. In the first section, the equity market forecasts haven't changed for the last 2 weeks when we did some downgrades. Over the last week, in terms of Aussie equities, we've seen the Aussie market off about 1%. And we have seen earnings up at the same time, largely driven by resources. So we've been speaking about the expectation we have for earnings downgrades. And we follow that through. That's largely what I'm going to focus on, the bits of this report this week that focused on that, and we are seeing some in the industrial section of the market. So PE for the market now down to 11.9 if you believe the E is correct. In the international markets, we saw a similar event for the US and China, and keeping in mind this is all in Aussie dollars. So China and the US off about 1% as well. Japan actually up 4%, and Europe down 4%. In corporate bonds, we saw not much to write home about. The triple B yield up just 2 basis points, so we're still talking about 8.3% there. So not particularly high funding costs for companies in Australia. In government bonds is a little bit more interesting. So to explain this chart, the grey area here is where the bond yield curve has been over the last 60 days. The dark line is where it's at the moment, and the dotted line is from last week. So what we've been seeing this week is that the 10-year rate really hasn't moved, but the 2-year and the 90-day rates have been shifting up and are now sort of bumping along the top of the range, the 60-day range that we've seen the trade. Now that's been the same story for a couple of weeks actually. The last couple of weeks have seen that whole middle of the curve shift up dramatically, and until this week we've actually been seeing falling at the long end of the curve. So very much a flattening of the bond yield curve, which tends to suggest in the past that we're starting to reach the end point of the rate cycle, and that rates will, while looking to rise in the short term, over the longer term, expectation is that they're not going to rise that much further. No real news in the property markets this week, so won't focus too much on that. The forecast, the Aussie equities piece, it's worth noting as well when you hit the 12-month forward earnings yield versus bond yield, so basically an inverse of the PE versus the bond yield. We like to use this as a bit of an indicator of when equities are cheap relative to bonds and when's a good time to get in. So we are actually starting to head back up into this, I'd say that back up into this sort of cheap range. I'd say that 3% difference between the earnings yield and the bond yield is relatively cheap. The concern I've got is how real that 3% is, and whether there's if we see another 5 or 10% in terms of earnings downgrades, that's going to bring that figure back down a fair bit. And while those downgrades are happening, it's unlikely we're going to see that much outperformance of the equity markets. Jumping through then to the heat maps, which I actually want to go to our interactive version of those just to explain them this week. What we've got here is a graphical representation of how big each section of the market is and what's happened to the 12-month forward earnings over the last week. So we see that within the industrials sector we've seen a number of downgrades. Mining and banks are a little bit more green. So I might jump through to actually look at the stocks involved there, and we can see that the ANZ sort of headed down and Sura's headed down, whereas CBA, Westpac and NAB have all sort of driven the rises there. Into resources, and we see that BHP has pretty much offset any of the effects of any of the negative effects of some of these other companies that have actually seen mild downgrades. But the most interesting story is within the industrials, where we are starting to see these currency-related downgrades that we've been talking about. So Aristocrat, a big exporter, BlueScope, Orica affected by global prices. So I think and Ansell as well. So I think what we're seeing there is that the thing we're speaking about, we think that this is just the start of it, and then we'll see a further downgrades within that area of the market. Skipping across to the small caps, while at the sort of headline level it looks like there are a lot of downgrades, when you do jump through to see where it is, it is a number of stocks that have had large downgrades themselves, which is sort of offsetting mostly neutral across that sector. So we really haven't seen that many downgrades amongst the small cap industrials just yet. Certainly due to currencies. Resources is also quite mixed. I mean, any time within the small caps, you generally find that these charts are quite mixed. But you can certainly see within resources there's a bunch of companies very strongly up, and also a bunch of companies that are very strongly down in terms of their earnings. Back to the dashboard, and the next point I wanted to focus on was getting into this Aussie dollar US dollar, where what we can see is the Aussie dollar up to around 108. That's been at the time of this writing, obviously it's been through quite a wild ride over the week, up to $1.10 and back down to $1.05. So this is just showing the weekly data. The interesting thing for me is this, looking at some of these consensus forecasts. So the darker line is consensus forecasts for currency to the end of 2011, and the next one's to the end of 2012. And so when analysts were last doing their numbers sort of back at the results, you can see that consensus forecasts were a lot lower, so at least 5 to 7% lower for both those. And most analysts have forecasts sort of trailing off over time. So we think there's going to be a bit of a step change, and as analysts start to put those numbers through their models, that's going to help to drive that change. It's worth noting as well, on a different topic, on the corporate bond side, we're not seeing too much in terms of the way of interest pressures there. The Aussie 10-year bond yield is drifting down, and interestingly for me is that the corporate bond yield, the spread between the corporate bonds and government bonds, is now, and this chart, just to put this in perspective as well, is showing you the difference between corporate yield bonds and government bonds over a very long period of time. And you see big spikes when you have things like the Great Depression and the 2001 Russian bonds and the Asian crisis and September 11 and things like that, which drive it higher. Over the last 30 odd years though, that 1.5 level really seems to be about the bottom, where it seems to the bottom of where it's traded over that time period, and we're getting down pretty close to that period now. I've actually shot down again this week, and part of that might be the concern about the US government and its solvency, but it's certainly interesting to note nonetheless. I'll skip the rest of the report, leave that for you to read through, except for just wanted to highlight back to the first page and focusing on that chart of the week, again on that industrials earnings, where what we're seeing there is we're seeing that this is showing the EPS 2012 EPS for industrials, and at the start of the year it was 487. As we speak, well, last week it was still at about 486, 487 type level. As we speak, it's getting back down towards 480, but really we're talking a less than 2% drop in terms of what we've seen in terms of forecasts. And for my mind, that's simply not enough given the moves we've seen in the currency. And